49% of Americans cannot pay a $1,000 emergency. And they are not alone. It means they are just one emergency away of getting into trouble, needing a loan, and spiraling into debt. That's why today we look at the 8 most common financial mistakes and the way to avoid them. And I'll be very honest and show you how many of those mistakes I'm actually making so we can compare our results. I got most of my inspiration today from Suze Orman, one of the best known financial educators. If you have come to this channel before, a lot is going to sound very familiar. But if you have not, or you're not very sure about how your finances are doing, please spend the next 10 minutes here. It's going to be worth your time. My name is Joram from Economia. Welcome back to the channel and let's get started. Not paying your credit card balance in full every month. You can always pay afterwards, right? And you get so many points and so many miles. It feels so good, right? Wrong. Not paying your credit card balance in full every month does two things. First, it lowers your credit score. It's especially important if you're living in the US or Canada. The second one, you end up paying a lot of interest rate on that debt, up to 27.94% in the US. And this debt has ballooned so much in the US. It's up to $1.1 trillion and it's been growing up and up and up over time. That being said, Japan is not that good either. Of course, the interest rate in Japan is capped at 20%, which is still very, very high. And there's also a lot of debt. We're looking at about $100 billion. If you have trouble paying your balance in full every month, you have two things you should do immediately. The first one is getting rid of your credit card. I know, the points, the miles, but that's never going to make you rich. Just get rid of it. Instead, you can use a debit card like this one that I'm using every day. It's a Visa one, and you also have MasterCard one. Exactly the same advantages. And you can never overspend because it's a debit card. You can only spend what's already on your bank account. The second point is paying back that debt. It is a debt that's going to slow you down. You cannot invest in your future. It's such a weight on your development. So you should concentrate all your energy on paying back this debt a little bit every month. There are a lot of different ways to do it. One that's the most recommended and one of the easiest one for most of the people is using the snowball method. And I've talked about it in a video that I'm putting right here and also a link down below. Concentrate on paying back your credit card debt and do not increase it. Not having 8 months of living expenses in your emergency fund separated from other savings accounts or checking accounts. Coming to think of it, a $1,000 emergency is not much. It's a small medical emergency. It's your car breaking down. It's your house getting flooded. Then you get in trouble because you do not have an emergency fund to cover it. Most recommend 3 to 6 months of living expenses on the side just in case. Suze Orman recommends 8 months. And coming to think of it, if you have a family and a mortgage, 8 months is not that much. How do you calculate how much money that is? First, you list up all your living expenses, as I can show you on screen. Nothing fancy, just the bare minimum you need to live every month. Then you multiply that by 8 and you know how much money you need. Of course, you are not going to put 8 months on the side in one go. You're going to do it progressively every single month. How you're going to do that is every time you're getting paid, you're going to create an automatic wire transfer to a new savings account that you never touch on the day you are paid. Not much money, $100, $200, and progressively your emergency fund is going to build up until you reach this 8 months objective that you have. And once you have it, you leave it there. You don't touch it, and it has to be immediately available for an emergency. For my part, I get that one right as well. What about you? Do you have an expensive auto lease or a car payment? Beautiful cars are really impressive. They are nice to drive around. People look at you. It really feels good, and you're just paying a little bit every month, right? Wrong again. You're just looking good and going absolutely nowhere. It's the same as for credit cards. you're paying so much interest rate. Actually, up to 22% a year, depending on your credit score, whether it's a new car, a second-hand, or refinance. And I'm not even talking about the price of insurance, gas, and parking if you are living in a big city. That's so much money. You'd be better off buying a car outright with cash, even if it doesn't look that good, and use all the money you're saving for investing for your retirement. And it's actually the same for any kind of loan you may have, except the mortgage on your house. Personally, I'm just with the mortgage with my house, so I'm good on that one as well. Check all your payments and make sure you don't have those high interest loans. And if you have it, please pay them as fast as possible, as we just discussed. Are you contributing 10 to 15% of your gross salary toward your retirement? Time is your biggest ally when you're talking about retirement investing, thanks to the law of compounding interest. In the US, the average salary is about $59,000 a year, and in Japan it's 4.5 million yen. Give or take, it should be $29,000 a year. It sounds very low, but because the Japanese yen went down a lot. So if you're only contributing 10% of it every month toward retirement, and you start at 25, by the time you retire at 65, you have put aside over $1 million. But if you're starting just at 35 and you reduce your investment time by just 10 years, you have much less money. This is compounding interest. If you are an employee and your employer is proposing a 401k retirement plan, and in Japan we call it a DC plan, you should definitely go for it. Even more if they are offering matching contribution. This is completely free money and it's very advantageous from a tax standpoint, so you should definitely max it out. Some employers are not offering the equivalent of a 400k or DC in Japan. Fortunately, there are a lot of different systems in every country that you can actually do it by yourself. In Japan, it's called iDeCo, for example. And after having contributed to that, if you still have some money, there are many more options where you can contribute additional money with tax advantageous account. Of course, in the US, we are talking about the IRA, Roth IRA, or HSA. It's going to be the superannuation in Australia. There's going to be the ISA in the UK. And in Japan, it's the NISA. And by the way, the NISA just changed this year, and we have had a video talking about all of it recently, so I'm linking it down below for you if you are interested to look at it. But that's not the only way. If you still have money after that, you can always go towards a brokerage account, but you can also think about real estate if you are studying or if it's something you prefer. And then you have commodities like gold, silver, you may have cryptocurrencies as well. There are many more options. Personally, I must say that I haven't put up to 10 to 15% this past year in my retirement because I just bought this house and I had a lot of expenses that I had to pay. So this is one of the things that I need to improve upon this coming year. Do you have a long-term asset allocation plan for your retirement investment? When thinking about retirement investment, we have to be very strategical in the way we are approaching it, because this can make the difference in how much money you have when you are retiring. When you are young, it's okay to go for high return, a little bit of risky investment, because you still have a lot of time, even if you make a mistake, to recover. When you are approaching retirement age, you want to be a little bit more conservative in your approach of investing, making sure that there's not going to be too much ups and downs, so you can see how much money, or at least foresee how much money you're going to have down the road for your retirement as you are approaching that age. So all of these are so important to think and reassess every year. Do you have life insurance to protect your dependent in case something happens to you? If you have a partner, a spouse, kids, siblings, or parents who depend on you, you have what's called dependents. And those dependents depend on your income, probably, or part of your income, to make ends meet. If you were to disappear prematurely or at a certain point in time, there's going to be a terrible shock for your loved ones, obviously, and they're going to have difficulties to make ends meet because they depend on your salary, and you do not want that to happen. So you should plan in advance, and that's why you need a life insurance. But don't go for whole life insurance like many others do. We're talking about investment, infinite banking, and all the kind. No. Usually the investment part doesn't give you a very good return. It's much more expensive in terms of premium and usually not the best deal. On the contrary, you should listen to the like of Dame Ramsey or Suze Orman and go for a term life insurance. A term life insurance, as the name indicates, is an insurance that has a defined term or length. You have many different lengths, usually it's 15 to 20 years, and it has a lot of advantages. The first one is that the premiums are much cheaper than a whole life insurance, up to 20 times for 15 to 20 years contract, as you can see here, an example for the US. Then your premiums go towards your coverage, nothing else. And the third one is that it's really easy to change and it's easily customizable depending on your circumstances that are changing. Maybe your family is getting bigger, maybe you need to cover for more or cover for less. We actually made a video some time ago that goes into a lot of details, so I'm going to link it down below. It's really important if you have any dependent to think about life insurance coverage, and I did, so I'm good on that one as well. Are you? Do you have a will, a trust, a living will ready for the worst case? I know it's not a fun topic, but you can check the statistics just like I did. We have 100% chance of disappearing eventually. So being ready in advance is the smart thing to do. You have worked hard all your life. Maybe you have a family, you raise your kids, everything is great. You've put money on the side and you have money for your retirement, some money investing. Maybe your house is even paid. And when you disappear, do you want the government to take care of everything and deciding what's going to happen with your money? Or do you want to make sure that the money goes to the people you really care for and the way you want it to be done? If that's the case, you do need a will. You need to talk to a lawyer. Maybe you need to talk to a notary, depending on where you live, to making sure that the way you want your money and your assets to be distributed and used is secured. There's also the tax angle. You can see taxes can be very high. Inheritance tax, although not so high in the US because you don't have a federal one, you have some state one. And you also have estate tax if you have a lot of money. But in other countries, it can be really high. Like in Japan, inheritance tax can be up to 55%. So you really want to manage your estate in advance, get a lot of advice to making sure everything is in order so you have peace of mind for your family and for the future. Are you ready for that? I must say I'm not 100% ready and I need to work on that. Have you checked the beneficiaries of all your investment accounts and all your life insurance policies in the past year? Setting up the beneficiaries of all of your investment accounts and bank accounts, as well as life insurance policies, is very important so that the people you care for have access to all of your assets. If you do not do that, it's going to be a bureaucratic nightmare for them to get access to your assets, and they will be already so stressed by your passing that they don't need that extra burden on them. Additionally, if you don't update it regularly, maybe some people that you're not so close with anymore will get access to some of your assets, and that may not be what you actually wanted. That's why it's so important to review it every year and make the necessary changes. I'm good on that point, I think. So I got 6 right out of 8 and 2 failures. To be completely honest, I'm a tiny bit ashamed about it, but I'm gonna immediately work on it and update you on my progress. How did you do? And do you have any corrective actions to take? It's completely up to you, but if you feel like sharing your results, please leave a comment in the box below. And I'm gonna leave a link towards the 8 questions to give you some references. If you like this video or learned something, please give it a like and do not hesitate to subscribe to the channel. If you're interested in money management and investment, I'm leaving these videos for you to check. Thank you again for watching, and until next time, goodbye.